Welcome to Market Buzz. I'm Greg Schnell, the Canadian technician and host of the Market Buzz. Each show, we do a deep dive into different industries using weekly charts to see what is happening on a long timeline. Please follow me on Twitter at Schnell Investor, and you can also find my blogs on gregschnell.com as well as StockCharts.com. So, a little bit of a rattly start to the week. The Dow down 1,000 day makes everybody think a little bit differently. I want to talk about the defensive market alignment that we're starting to see, why I think that's important, and why it might be a bigger correction this time than just the bounce off the 50-day moving average that we saw, or that we have typically seen with the S&P 500. Last week I changed my tune to more cautious after being bullish for 8 weeks or so. The market has had a lot of weak points start to show up, and we need to talk about that. And I don't think there's any rush to deploy your capital as things improve generally. We're in a bit of a state of really awkward non-confirmation where basically the market was going up. Lots of stocks weren't going up, but the big ones were. And so everything looked okay. Underneath the surface, lots of damage. You've probably heard everybody talk about the Russell and all that kind of stuff with different sorts of indicators. It doesn't really matter how you get there. What's important is understanding what's really happening behind the scenes. So I want to talk a couple of things. First of all, this is an article I wrote today. It's on StockCharts and on gregschnell.com. And on gregschnell.com, you'd go to free tools, and it would be under articles and videos. But the point being that Jeff Kilberg posted on his Twitter feed this morning that, or it might have been on CNBC, that he thought kind of 1.05% would be where the 10-year bond yields would bottom. And for me, just looking at this chart, I actually think it's a little bit lower. I think it's actually just under the 1%. That would probably make everybody freak out. Yields are back below 1%, blah, blah. And this blue line sitting in the sand here is pretty important. So for me, that was one of the places that I would look. Anyway, Jeff's a pretty smart guy, so I don't want to doubt his work. What I was trying to figure out is what made him pick that line, and I still haven't figured it out. On the next chart, what I mentioned was perhaps it was the Fibonacci levels or something that he was looking at. But when I pulled down, and you could have pulled it off this big one down here, but I pulled it off kind of not the intraday low of the whole panic selling thing, but the kind of I'll call it a multi-day bottom here. And then we bounced out of there, and we've run up. So there was a small pause at 38.2% retracement. These are a little bit hard to see, but 38.2%. On Monday, we bounced off the 50% retracement. And now the real question is, where will we go from this level? Will we get all the way down to the 61.8%, which would be about 9.98, something like that? And if we don't, like if we bounce here, nothing wrong with bouncing at 50%. But I think the reason to be aware of this is a lot of the market trends have changed. Basically, this part was all growth stocks. And then once we got into the November timeframe here, all of a sudden we saw a rip in the value stocks. We had the value stock, or the growth stocks, basically start to pull back in February. And then recently the gold sorry, not gold, but oil and the banks have pulled back, let's say from late June, have started to pull back. And now here we sit, and the question would be, if we bounce from here, what do we move into? And we don't really know that yet, and I'm going to talk about that in a little bit. But the one other clue that we have on this chart that a lot of people don't use is something called the PPO, which is the percentage price oscillator. It looks the same as the MACD. It is similar to the MACD, but it uses the percentage change. And the value of using the percentage change is you can use, it doesn't matter as price changes because you're changing by a percentage amount. And what we see is, going back to 2011, almost all of the pullbacks in the bond yields have stalled around the 5% level. Now that could be that they stall and they bounce back up like they did here in 2016. They stalled and they bounced up and then they moved lower again. But essentially 5% is kind of as bad as it gets without, I'll call it studying disaster, which was the 2020 or the 2009 period, 2008, 2009 period. We're at a place here where typically we're so oversold. This is a good place to expect the market to turn back. And we had the same thing on the upside here where we got back up to the peak of 2016 after being well down. And then that was a good place just to be aware of that you're up nearing a high and you should at least be aware of the potential for the market to start to soften. Doesn't mean it will, but we're at a condition where behavioral, when we look at the behavior of how markets have responded in the past, this is kind of as bad as it gets for a normal market. Now, if we had a brand new pandemic start up tomorrow and we'd have to repeat the whole thing, I realize we've got some variance going on, but to me it looks like a normal pattern. And so somewhere here, 5%, 6%, something like that, we want to be watching for a reversal in the 10-year. And so with that, I'll let you go read the article. It's a quick read, couple of minutes, but the point being just understanding that we are at a relatively significant level, and whether it's the bounce off the 50%, like I just showed you, of the Fibonacci retracement, the Jeff Kilberg line, the Greg Schnell line, and I read a Dave Keller article today that he thought it was in this same range, 0.9 to 1.0. So Dave and I are on the same page. But overall, what I want to look at is just where can we expect this bond market to turn, and when it does, how will we know and what will we be looking for? So the reason I don't think that we're just going to come down and touch the 50-day, let's just go get an S&P chart. Actually, I'm going to do it this way. I'm going to go into the dashboard, and we're going to pick the S&P 500 chart. We're going to go look at it. But you can see here on this chart, this is the S&P 500 daily, and almost every time we have bounced off the 50-day, with one exception. In March, we dipped below it and then reversed right away. What's different between then and now that I don't think this 50-day bounce holds? Obviously, that's just my interpretation of the chart. It all looks the same from this perspective. What I want to talk about is the bullish percent indexes and how they look as the market's been running up and what might be causing a change in the situation now. So here's the bullish percent index for the NASDAQ Stock Exchange. And the next thing we're going to talk about is the New York Stock Exchange, because the two markets behave different, but at some points they also come together or behave similarly. So what we see going back, this chart starts in 1995 on the left and goes to 2021. This is when the bullish percent indexes started at StockCharts. So that's why the chart goes back this far. They started calculating the percentage of stocks above the 200-day moving average on the lower panel. And so let's go back and look at that S&P 500. So this is the 200-day moving average here. And it's basically a long-term moving average. So we can either use a daily chart, whatever, crank up the time, and just say how often does it go below the 200-day moving average? And the right answer is not very often. But let's convert that to a weekly chart. And what you see here is the green line is a pretty good trend barometer, and when you go below it, you're probably in a corrective position, which we were back in 2018, and then it got support all the way through 2019 at that 200-day or 40-week, and then we broke it in 2020, and now we've been well above it. And this is for the S&P 500. I could go to a chart like Freeport-McMoRan, and we've been above it for 10 months or whatever, and now all of a sudden we're testing the 200-day moving average. So the question is, are the markets starting to break down? Are we about to have a big reversal here? And so we can use these two factors, the bullish percent index and the percentage of stocks above this 200-day moving average. So just because the S&P 500 is above the 200-day moving average, well, that's helpful knowledge. What happens there is the large caps like Amazon, Microsoft, Apple can force that index to behave really strong compared to the rest of the stocks. So the small caps could be crashing underneath. And so if we go to IWM as an example, which is the Russell 2000, we're sitting right on the 200-day moving average or the 40-week, except that the S&P 500 is nowhere close to its 200-day moving average. So just looking across the different groups of stocks, we're seeing different behavior, and the large cap index, the S&P 500, is covering or muting the view of what's going on underneath the surface with a lot of other stocks. So when we go to the bullish percent index, this keeps track of the number of stocks. I'll just go back here a couple. The number of stocks on a P&F buy signal. And so what's a point and figure buy signal? Well, a stock is on a buy signal not just when it's in an up column, but when it hasn't made a lower low. So this was the first time back in here. So this is January 2021, February 21. And so the market started to rally, fell back, rallied, fell back. And the reason this is the first sell signal is it's the first time it made a lower low. So all of this jockeying back and forth through 2020, we kept making higher lows. And as long as we were making higher lows, all of this is on a buy signal. Now, we get up here and we make a lower low. This was a sell signal. We immediately reversed and made a new buy signal right here. And so far, we're still on a buy signal. Everything looks very bullish. Well, when we take that on each individual stock, that's starting to change. And so this buy signal on the bullish percent index, we take each stock within a group of stocks. So the NASDAQ, all of the stocks listed on the NASDAQ, and we use that as a group and we say, what percentage of those stocks have a buy signal? And by doing that, we can get a pretty good idea. So what we can see here is that since the 2020 low, where almost no stocks were on a buy signal, we bounced up and we ran up. And in early 2021, as we headed into that February meme stock high where all of the electric vehicle stocks were running and Bitcoin was running and basically anything with optimism was running very well, we ran up pretty high. And then we had a big pullback. And then we've chopped around here. Now, don't get me wrong, being above 50% is still good. But what you'll notice is really for the first time since the October low, we're down at, we have less than 50% of the stocks on a buy signal as of Monday. And on Friday, I think it was, we're currently at 46, and I think on Friday it was 49 or something. So, so this is in effect as of Monday, I think it's July. Well, this might be live. The bullish percent index might be live, but the NASDAQ percentage above is based on yesterday's reading. And I'm recording this on Tuesday. So we're sitting here potentially at a low point. This would be the bullish perspective. But what I'd like to draw your attention to is when we go back and look how the market behaves after having significantly strong runs, is when we start to pull back, these valleys can last 3 to 6 months after we come off an extremely big high. So when we look over here on the right, we were up at 80%. We've pulled back. We're now down at 45%. And this green line is the current level as of Monday's close. Well, you can see typically after you've been up really high and then you come down off of that, typically you stay down there for a while. It's not like a 1 week move down. Here's an example in 2013, 2014, the market came down, bounced for a few weeks and then came back down again and bounced again. And all through this period, the market was running up, but again, it was starting to put more stumbles and stops in place. So looking at the big picture for for the percentage of stocks above the 200-day moving average, well, the S&P looks nice and high. There's a lot of stocks that aren't above their 200-day. And as a matter of fact, more than half of the stocks on the NASDAQ are below their 200-day or 40-week moving average. That's pretty considerable. So when more than, well, pick a number, 55% of the stocks are below that long-term average, that just suggests caution, right? So we're here back in 2002. We had the big rally off the September 11th event, and then we pushed up, and then we fell back down. And all this time, while this percentage of stocks above the 200-day was weakening, the market was giving back. And then in 2004, we actually gave, this doesn't look like much, it was a pretty significant decline, I think in the order of 20% by the time it was all finished, and that kind of bottomed out in September, and then we started to rally our way out of the hole. And you can see we never really got that bullish enthusiasm all the way back up to the highs. But in general, what you're looking for is whether you're declining or improving. And in this current case, we are clearly declining. Just a few weeks ago, we were at 62%. Now we're at 44%. So we're seeing a dramatic change in support for these stocks as they get to the 200-day moving average. Lots of long-term investors will look to buy down at that level. The problem we have is that there's big gaps here where it can spend a whole bunch of time down below this 40-week moving average as a group. And in general, when you go back and look, most of those are marked by periods of pullbacks in the market. So you can just see how they've been dropping quite significantly. So that's for the NASDAQ. And the NASDAQ, because it has more growth stocks and biotech stocks and that kind of thing, typically doesn't get the strength of the old New York composite, where this data shows much higher readings currently. So we were sitting up around 90% of the stocks, or 88% of the stocks were on a buy signal as we came through the November surge on the back of the COVID vaccines. And now we're giving that up. We've rolled over and we're down around 70%. The problem here is when we've done that before on this index, you can see back in 2010, we spent almost 4 or 5 months down here. In 2011, we spent 3 or 4 months down here making a base and starting to improve. In 2014, we had the same sort of dynamic where we just didn't have the same thrust power higher to keep the market moving up. And so one of my main concerns here is that not only did our bullish percent reading for the New York Stock Exchange make its lowest level since November, when the COVID vaccines were announced, that was new 6-month lows or 8-month lows. The problem is the percentage of stocks moving below the 200-day moving average is increasing, and we have less stocks physically staying above the 200-day. Now, we still have 67%, whereas unlike on the NASDAQ, that number's already gone below 50%. I think the biggest thing to watch out for here is that when the market has had this big heady run, it can actually spend some time getting positioned for the next run, but it actually needs to exhale for a while and then it starts to come in. So all this time since 2020, since the COVID pullback, every time we've bounced at this level, but the difference was we were on a rising trend in terms of stocks moving above their 200-day moving average. Now we're on a declining trend, and that's one of the reasons that I think it's more concerning here. You can see in 2018 we declined to this level. We really couldn't rally back above that 70% level, and these two red lines are put on here by me, but at 70%, that's kind of a really strong support level, and we held it all the way through 2021 so far until lately. And then when you're above sorry, when you're above 65%, that's good support level. When you're above 70%, you're just in a raging bull market. 2/3 of the stocks are on buy signals. Stay on a buy signal and try and enjoy the ride. So these changes are sitting there, and it's one of the reasons that I think on this particular low, after Monday's pullback, we need to be more cognizant of the backdrop and can we really break out. So I ran some scans, and one of the scans I ran was to see the full stochastic tends to be a relatively quick mover. And what I wanted to see is how many stocks actually have improving full stochastics, and or how many indexes have improving full stochastics. And so when I did this, what you see here is when I look, beverages is a consumer staples, personal products consumer staples, specialized U.S. consumer services, drug retailers are consumer staple, or at least a defensive group in my mind. Diversified REITs are defensive. Electricity, utilities is defensive. So when you look through all of these different sorts of groups, the majority of stocks, or the majority of indexes that are actually putting on a bullish turn here with just using something simple like a full stochastic, is relatively short. So that it's one of the reasons that I think we need to be more cautious here. What you don't see here is oil's not on this list, banks are not on this list, none of the growth areas from the NASDAQ are on this list, and all of these other groups are already trending lower and have been trending lower for a while. But the big issue now is they're just really focused in on the only things holding up are the defensive sectors. And so to me, it's an important inflection point for us to look at. And somehow this airline stock or this airline index got a bullish twist. And I don't know, I'd have to go back and look what I did on the scan. But anyway, when you see this, it's trying to rally at least, and it's made a pretty big turn. So perhaps because of the distance it was off of the low, it's actually the full stochastic starting to turn up or something like that. But my main point would be when we look through these charts, and let's just set them to weekly because it cleans up the data a little bit. And so I put all of these stocks in a specific chart list, or these groups. So when we scroll through here, we can just view all 10 per page. So what you see is this is a daily chart, and we can just quickly click over and look at it on a weekly basis. The point I want to make, I have to go and apply the style. The point I want to make is when I look at these groups, and we don't have to spend a lot of time on them, but just real quick. Okay, so this one's down, and maybe the full stochastic starting to turn up, so that's a little bit better looking. The one thing I like about the airline is it's coming down to around the zero level. If anything, I wouldn't mind trying to buy it there as it bounces. That can be a really nice signal. Here's U.S. beverages making new all-time highs as the markets, as we've got that weak breadth that I just mentioned. Personal products, new all-time highs. Consumer services just starting to turn up here. Food and drug retailers very close to new all-time highs. Diversified REITs have been pushing up, getting back above any of the post-COVID levels here. So that looks good. The utilities, these are still gyrating sideways, but at least they're starting to turn up. The food and beverage index is starting to turn up. So again, another defensive. And then when you look at fixed line telecommunications, you see that it's you've got a horizontal level here to think about. We're getting down to kind of as bad as it gets. But when I look at this as a group, it's not a chart I'm interested in, but it's particularly not that great. I wouldn't mind if this started to bounce right here after coming up and then turning, and you start to get this sort of price action where it actually goes marginally above, comes back to zero, and then takes off again. That's a pretty strong place for me to look. U.S. food and wholesalers, like breaking out to new all-time highs, defensive again. Industrial machinery, it's just kind of jogging sideways for 3 or 4 months. This one may or may not be defensive. I'd probably call it more growth-oriented. Household goods, this one hasn't done anything for months, but again, another defensive area. Home improvement retailers, they've done pretty well. I mean, everybody's talking about how great they've been, but really they haven't done anything since late March. Been charging sideways, briefly moved up and then moved down equally quick. But you're sitting right here, but it's still an area of consumers investing in their homes, so that would be growth. Household products, this is defensive. So you're sitting here, this is looking to turn higher. It's making new 2021 highs. That's pretty good. Full line insurance, it's been pulling back for 6 weeks. Can it start to turn up? That's a good question. Here's U.S. life insurance index still declining. Nothing there for me. Industrial and office REITs trying to break out to new all-time highs here, so that's pretty bullish. Multi-utilities just chopping around here, so hasn't really turned up by any stretch. But the main thing I'd say here is, again, another defensive doing pretty well, holding up nicely. And when we look at waste and disposal, there always seems to be garbage. Anyway, this thing's starting to turn up again. Drug retailers still on a decline, but coming down to the 40-week moving average. Can it bounce there? Good question. But I hope what you see, or I hope that what I see is something that you're feeling too. When you look at all of these, for the most part, they're defensive. It's not software and semiconductors and automobiles. It's a whole bunch of defensive sectors. So here's real estate generally. U.S. soft drinks index breaking out to new all-time highs this week. So Pepsi and Coke, I guess. Looking at specialty finance, pushing up a little bit higher here. Telecommunications, just really not that great, whether it's mobile or fixed line. U.S. gas, water, multi-utilities, holding in here but not doing anything either. But again, all of the stuff I see in this whole thing is a defensive backdrop. And, whether or not this is an accurate way to look at it, it was just a quick scan I did to try and find something turning higher. And the bottom line is everything I'm looking at suggests to me a more defensive backdrop, and we're really not seeing the growth areas of the market lead here. Here's the water index. And again, I'm trying to break out to new multi-year highs or all-time highs. That looks pretty good. And here's tires. This one's pulling down and trying to bounce off the 40-week moving average. I think when I look at this, I want to be more cautious. So when I go back to my PowerPoint here, I changed my tune to more cautious. The market has lots of weak points. Deploy your capital as things improve generally. I don't think there's any rush here because of that backdrop. And we've still got a couple more, potentially a couple more playoff games. So if you're interested, I've got a special at gregschnell.com called Fans in the Stands Playoff Sale. If you didn't get an alert last week saying market is turning bearish, you should be cautious. Maybe you'll enjoy my membership because that's what my members received. Save $363 and get an annual membership at gregschnell.com/sports for just $4.97. Thanks, everybody. Thanks for taking the time to join me at Market Buzz. Market Buzz airs Wednesday at 10:30 a.m. Eastern Time. You can also see the recordings on StockCharts TV YouTube page. Thanks, everybody. Bye-bye.
Hey guys, Dave Keller here with StockCharts.com. Thanks so much for watching our video. If you enjoyed it, and we hope you did, hit the like button right below. Also, we have so much new content every day. Consider subscribing to the channel. Just hit the subscribe button in the video or right below. Thanks for watching. Stay safe. Have a fantastic day.